So it's tax time. And I would tell you what, if you are a self-employed borrower, you are probably working with your CPA to get your taxes filed, to get all your receipts together, get everything to them, to either get everything filed by April or to get an extension done to file in October. So many self-employed people think that it's impossible to get a mortgage loan or that it's very difficult. I hate hearing this because it's just not the case. Now, what you have to remember is the mortgage loans that we do today are full income qualifying loans. Back in 2008, you could just tell me what you made. That's not the case today in 2024. So for self-employed borrowers, what this means for you is that I've got to get your tax returns, your business returns, your K-1s, your self-employed documentation to be able to calculate your income. Now remember, when we're calculating income, we're not using your gross sales or your gross revenue. It is going to be your net income that you're paying taxes on or that you're showing to the IRS that we're going to be able to qualify you on. So your CPA's job is to lower your tax burden and save you money. However, your CPA may not know that you're looking to buy a house. A lot of times, if you're writing off too much income, you may lower your net income to where you may not qualify or may not provide enough net income to be able to buy the home that you want to buy. So if you're self-employed, guys, I would highly recommend sending to your lender your taxes before you file them. What we are able to do is do a thorough and proper income calculation for you and let you know how your net income looks on the taxes that you're going to file. Now, what I would say is, if you have enough income, great, go ahead and file them. But if you're not filing enough income to buy the house that you want, we can offer you that knowledge. You can go back to your CPA, and if something needs to be amended, you can amend it. So hopefully this has helped. If you're a self-employed borrower and you guys are looking to buy a house, I would tell you the critical thing is communication between your CPA and your mortgage person. A lot of times we will have a great rapport with your CPA. We can talk to them directly. A lot of times that can help when it comes to looking at your tax return and maybe giving a little advice or a little help to your CPA. But it doesn't have to be a difficult process, guys. Self-employed people buy homes all the time, and you don't even have to put down 20% like a lot of people think. So I will tell you what, if you have any questions, definitely reach out to us. We're here to help.
Just a quick question. As far as the self-employed, you say you don't have to put down 20%. How's that usually? What are they looking at then?
So if you claim enough income, like you're the same borrower as any W-2 salaried person, you still qualify for all the same down payment and all the same programs, right? It's just that, are you claiming enough income to put down 5%, right? Because like, do you have an LLC or a Schedule C, or how do you do your taxes?
Not yet. I'm doing
Not yet? So, if you generally people like if you're just a sole proprietor, right? And you have your 1040 and you file your taxes and you put your self-employed income on a Schedule C, right? So you have gross sales or gross revenue. The middle of that Schedule C are your expenses. And then at the bottom on line 31 is the net income I can use to qualify you, right? So you may start out with $100,000 of revenue, okay, but that's not your income unless it says $100,000 on line 31, right? So, but what a lot of people don't know is that I think it's line 13, 14, 15 of the Schedule C is depreciation. So if you own a building, okay, or if you have a car, right, you can write off miles that we can add back to your income. And if you can depreciate something like equipment, right, equipment depreciates, all right, write depreciation off on anything that you can, because literally depreciation adds back dollar for dollar to what you have expended, right? So if you had $5,000 of depreciation, we know that you didn't have $5,000 of expenses, okay? You're just depreciating an asset. So I get to take that $5,000, and if you claim 60 grand in income, I get to make it 65. Right. So what a lot of people will go back and do is they'll go back to their CPA and they'll say, well, Ashley had mentioned something about using as much depreciation as we can. And their CPA will say, okay, well, cool. Let's take this depreciation this year. Let's not push it forward 5 years. Let's take it now. Right. And they'll increase their depreciation, which increases their income. and it didn't cost them any more money. Right?
Rules of the game. Okay.
Yeah, no, you just got to know.
Just gotta know. You're right.
Right.
Oh man. Okay. That's something to look into.
Yeah.
This video was produced by Visionary Masterminds.